Wall Street sells a specific promise. Pay top dollar for a brilliant portfolio manager, and their expertise will decode the market to deliver outsized returns. Let's test that promise using a historical case study covering a massive 15-year bull market. Imagine you invested $10,000 at the start of this run. This chart shows the total market benchmark. If you simply left that $10,000 in the broader stock market and did absolutely nothing, your money would have grown to $115,000. But look at the trajectory of the average active mutual fund over that exact same 15-year period. Managed by highly paid experts, the identical investment only reached $57,000. The market didn't crash. In fact, it was booming. Yet somehow, nearly half of the investor's potential wealth simply vanished along the way. Tracking exactly where that $58,000 went requires looking past the stock picks and into the plumbing of the financial industry itself. John Bogle spent decades analyzing these numbers. He found that active managers were frequently generating solid market returns, but those gains were being eroded by a gauntlet of what he called frictional costs. We can see the first layers of that 5.7% annual drag in the fees. There is a 1.2% charge for management, followed by a 0.5% for front-end sales commissions paid just to buy into the fund. Then come the internal leaks. Because funds keep some money in idle cash, you lose 0.6% to cash drag. Add another 0.7% for the transaction costs incurred by managers constantly buying and selling stocks inside the portfolio. Finally, all that frantic trading triggers capital gains. Those taxes shear off a massive 2.7%, leaving the actual investor with a shockingly small fraction of the original return. When these layers are combined, the mutual fund industry operates less like a wealth creator and more like an expensive toll booth, extracting capital from the market's natural upward growth. An annual drag of 5.7% might sound trivial in a single year, but stretched out over decades, it acts as a wealth-destroying parasite. This is the tyranny of compounding costs. To escape this mathematical trap, Bogle championed an aggressively simple solution: the retail index fund. Instead of paying a suite of experts to guess which stocks will win, an index fund simply buys every single stock in the market and holds them forever. No guesswork, no frantic trading. By doing absolutely nothing, the fund avoids the need for highly paid analysts and bypasses high transaction fees entirely. The cost of running the fund drops to near zero. It all comes down to a definitive equation: gross market return minus frictional costs equals net investor return. By removing the costs, you mathematically guarantee that you keep the market's wealth for yourself. Bogle often framed this philosophy using baked goods. He called active management a donut, sweet, built on fleeting speculation, but ultimately undernourishing. Indexing, by contrast, is a bagel, built on the tough, crusty, reliable nutrition of long-term corporate earnings. Wall Street initially mocked the idea, calling it Bogle's folly. But relying on the math of the bagel transformed Vanguard from a ridiculed underdog project into a multi-trillion-dollar behemoth. The raw data was impossible to ignore. Bogle's mathematical proof eventually turned the early heresy of indexing into industry dogma. The modern financial industry still generates billions in profits by convincing the public that investing must be complex. But the most effective wealth-building strategy relies purely on simplicity. Bogle's definitive rule for the long-term investor is absolute: stop looking for the needle and simply buy the haystack.